industry. And I have with me today an expert panel from KPMG to discuss financial and business impacts of COVID-19 on the financial services sector. We're more than halfway through to the finish line with Chamber Talk. Today, we're conducting our 13th session out of the total 23 set for the program. It has been an amazing journey with very interesting topics that covered various aspects of doing business. For a quick recap, and for the first time of what we've covered to date, we've tackled post-COVID-19 strategic thinking, supply chain resilience in turbulent times, how impacted businesses can manage employment relationships, accounting and disclosure implications of COVID-19, crisis management, education as an enabler of economic activity, top 10 strategic technology trends that organizations need to explore in 2020, what can the UAE consumer and retail businesses do to weather the COVID-19 crisis, managing fraud risk, liquidity solutions, COVID-19 and force majeure, and finally, protecting the business by protecting the family. If you missed any of these webinars and you would like to watch them again at your convenience, please visit our Facebook page for the recording. I would like to bring into your attention as well that you can watch this session in Arabic via the link that will be shared with the team, by the team in the chat box, and that we'll have the last 15 minutes of the session for Q&A. So please don't hesitate to share your concerns and queries related to the topic with our guests, who will try to accommodate as much as possible of it towards the end of the session. So, as mentioned earlier, our discussion today will cover the impact of COVID-19 on the financial service sector, and we'll tackle both the banking and the insurance industry. The financial services sector is one of the main sectors that was directly and indirectly impacted by the pandemic. The impact took different forms and shapes and has disrupted participants in the sector as well as the end customers, of course, passing by all the stakeholders in between. Every one of us have received during the last couple of months a number of messages and emails on adjustments to operating hours of different financial service companies, or on temporary or permanent closures of branches of the banks that we bank with. We've noticed announcements of several new services going online, and a clear change in the normal operating model of these businesses. All of the above represent just the tip of the iceberg. Probably only participants in the sector know what's underneath it and realize the real impacts of the pandemic on the sector in the short term, as well as on the medium and the long term. We are talking about an increase in non-performing loans and related provisions. We are talking about increased liquidity pressures and revenue compression, and of course about imminent number of cyber attacks and financial fraud attempts targeting participants of this sector in specific. It is anticipated that the impacts are not going to be short-lived, but will extend to the period post the pandemic, especially with the higher required investments to accelerating digital transformation and strengthening cybersecurity and risk governance, not to mention managing the complexities in credit risk assessments with the potential deterioration of the credit portfolios or profiles of existing and potential new customers. At the time, the financial sector is expected to play a major role in the recovery and the growth of the economy. There is no doubt that the participants operating in the financial services sector have promptly responded to the evolving situation, but the way forward embeds many challenges and opportunities and leaves us with a definite conclusion that the banking and insurance sectors will change as a result of the pandemic. That's why we have with us today the team from KPMG, who will try to highlight all of the above in this interesting session. A brief intro about our panel for the day. I will start with Abbas Basrai, who is a partner and head of financial services at KPMG Lower Gulf. Abbas is a banking specialist and focuses on audit and advisory services within the financial services sector. He has considerable experience of working with banks, both conventional and Islamic, sovereign wealth funds, investment and asset management companies, and private equity funds, and has worked for KPMG London before joining KPMG Lower Gulf. We also have with us Adil Abed, who is a partner and head of insurance practice at KPMG in the Lower Gulf. Adil has more than 16 years of experience advising organizations in general insurance, life insurance, and wealth management across the Middle East and Europe. Adil also represents KPMG on the XBRL steering committee, headed by the UAE Securities and Commodities Authority, in conjunction with the two local stock exchanges. And finally, we have Slim Ben Ali, who is a director in financial risk management practice in KPMG Lower Gulf. Slim is a financial engineer with more than 15 years of experience providing advisory to the financial service sector, specializing in financial risk management, investments, and capital markets. He has also worked for two other Big Four firms in Canada and the Middle East, where he was providing treasury and financial risk advisory to several financial institutions, including banks, funds, asset management companies, insurance companies, and private family offices. Apologies for the lengthy intro, but the topic is very hot. Now I'll pass it to Abbas to take it forward with the presentation. Abbas.
Thank you so much, Sultan, and kind words in the introduction. Look, first and foremost, I would like to thank everybody attending this webinar, which will talk about finance and business impact of COVID-19 on financial services sector, which has been kindly organized by Abu Dhabi Chamber. Needless to say, I hope that you, your families, and colleagues are all safe and well and adapting to this new way of working, which, if nothing else, has given us all an opportunity to connect. So, as already mentioned, agenda for today, we will try and cover about 40 minutes and then take your question and answers. So please actively participate and send any questions that you may want to be answered. Having been through the 2008 crisis, it is clear that the distinction between 2008 and 2020 is that 2008 was a financial crisis, whereas 2020 is a health pandemic, resulting in stress in almost all aspects of the economy. And that has brought about numerous challenges for the financial services sector at large. However, while there is uncertainty, there are challenges, there is curiosity around what the future holds. These situations also bring about opportunities, and in today's session, we plan not only to talk about the problems, but also the solutions. On that note, I would like to start off by sharing my thoughts. I like to start on a positive note and share what we have been hearing from our clients across the region in terms of positives that have emerged from this pandemic over the past few months. Because amongst the uncertainty, we've received consistent messages around the good that has come out of this situation. But before that, let's talk about what we see as the key economic impact. The tourism sector, hotel occupancy rates have tumbled. We've seen a suspension of majority of passenger flights and travel restrictions, which will have an effect on the travel and tourism contribution to the GDP. Although there have been significant steps taken to address this, tourists, in my opinion, will still take a slightly more cautious approach. This has resulted in demand being contracted, especially in non-essential goods due to salary cuts and even unemployment increase. I mean, especially the leisure goods and services industry was put on hold by the temporary lockdown. Because of the demand going down, there will be, unfortunately, I have to say, a knock-on effect which may result in certain companies, businesses running a tight ship and may result in taking the very difficult decision to shut it down. We've seen a bit of that through already. And I'm not just talking about locally or regionally, but globally as well. Large organizations have and are filing for Chapter 11 bankruptcy. We've seen a toll on unemployment levels going up as well. And as a consequence of the points that I've discussed, unemployment has sharply increased. Due to this, a considerable amount of expats are and will be looking to go back to their home country. A couple of months back, Oxford Economics estimated approximately 10% of the UAE population that could potentially leave in the next few months. Only time will say if that's true or not. Seen a toll from liquidity front, so income reduction will lead to an increase of savings utilization, especially with expats leaving the country as well. They would most likely transfer their savings to their home country. Coupled with a low oil price, which is pressure on government deposits, we'll see a bit of stress around liquidity. answering these challenges, I have to commend the local authorities and regulators who've really stepped up very well. So I'll take the banking side as to what's happened within the banking front and then insurance. So on the banking front, regulators and governments in the region, specifically in the UAE, have acted proactively and very, very effectively to stabilize the economy. The banking sector has been supported with the stimulus packages in the billions of dollars announced by all, and there have been a clear signal to the market that the engine of the economy will keep running with state level support. These measures include guarantee schemes, payment referrals, cancellation of banking fees, to name a few. We've seen low to zero funding has also been made available, reflecting the willingness and the ability of governments when needed. The Central Bank of the UAE came out with a test program which provided a lot of relief, which included a 50 billion worth of zero interest rate facility for banks. And for those banks who were participating in the temporary relief program given to the private sector businesses, up to about 6 months of no fees, penalties, interest to be applied. We've also seen Abu Dhabi government has allocated close to about 3 billion dirhams to the SME guarantee scheme, which has been managed by Abu Dhabi Investment Office. And this is in order to stimulate financing by local banks and enable SMEs to navigate the current difficult market environment. On the we've seen some other initiatives regarding bills and municipality fees. We've seen bank fees going down for SME, minimum balances going down, requirements. We've seen a 10% reduction of water and electricity bills, including residential and commercial bill for 3 months, and also a reduction of municipality fees imposed on sales at hotels from 7% to 3.5%. In addition to the regulatory impact, and these are some of the taken, we've seen other regulatory buffers introduced as part of the test program. Just to name a few, a 95 billion dirham of current liquidity buffer to free up cash for lending purposes. We've also seen capital requirements and reductions around what do you need to hold against SME loans going down. We've seen some relaxation on concentration risks as well. Moving on to insurance, I think one thing was very clear. DHA came out and said treat COVID-19 on priority. All health facilities must classify the confirmed and suspected COVID-19 cases as emergency cases, and hence they have to be treated with a priority, and insurance companies were asked to honor such cases. Insurance Authority has requested insurance companies to start submitting various different reportings in order to understand the potential impact of COVID-19, both on the insurers and also the market as a whole. Also focus quite a bit on operational resilience plan, where the authority required insurance companies to submit different data points in order to understand the operational impact of COVID-19. And some of that included what is the expected impact of the net claims on companies and other additional costs impacting companies like operational liquidity and possible failure of reinsurance. We've also seen discounts on premium renewal that have come in. This has mainly happened for motor policy vehicle plans, whereby the insurance authority amended existing regulations in place for motor vehicles and suggested to insurers to consider offering various discounts. For instance, approval of granting insurance discounts up to 50% of the insurance premium for frontline workers. Although this is not mandated, we are beginning to see more and more insurers opening up to this opportunity and doing their bit and trying to give back to the community. We've seen grants of partial refunds on existing insurance premiums and also offering reduction for policyholders renewing insurance policies in the proportion to the periods whilst, for instance, this realization process was in place. We see possibility of linking premiums for new and renewed policies with, for instance, number of kilometers driven by the customers. Insurance in this market who are beginning to offer such services in line with what we've seen in the international markets as well. And this will give a rise to possible implementation of the telematic opportunities, which I believe Adil will talk about when he talks about insurance sector. Regarding the regulatory reporting insurance authority perspective, there's been a lot of relaxation, which is very well needed, with deadlines extended for financial statements, e-forms, IFRS 17 submissions, and so on, including stress testing guidelines which were sent out in order to understand the potential impact of COVID-19 with details of underwriting risk and solvency risk. So then moving on to focus areas for the financial sector, and I'll talk more generally from a financial sector point of view, and my colleagues Slim and Adil will talk more specifically from a banking and insurance sector perspective. But before I talk about any of those 5 things that you see in front of you, I want to talk about customer centricity. I think Sultan mentioned that in his introduction. Customer focus has gone up and will be beneficial for the sector as a whole. Interaction with consumers, customers has completely changed and will change, and every now revolves around making the overall experience easier, whether it be paperless banking, cashless transactions, branch interaction. One thing is clear, that customer features at the very top of the agenda of board members, and that will ensure that the trust remains in the system, particularly given what we went through in 2008 when the global financial crisis happened. So following the uncertainty presented by COVID-19, there are increased demands to replace manual operations by digital infrastructure capabilities in supporting similar crises. And this is where digital transformation has seen a lot of acceleration in terms of where organizations wants to be in the next sort of 12 to 18 months. Customer centricity has resulted in greater speed, pace, fast tracking of digital evolution, with new partnership with fintech players being explored faster than ever before. Acceleration of existing plans and introduction of new products, whether it be tap and pay, worker remittance, remote KYC, etc., all are being thought through and introduced to address the current situation. Now, as you move more towards digital transformation and the new way of operating with customers, that opens an element of different risks, namely cyber and financial crime. Operation risk has been an area that organizations globally have been playing catch up on. Now, with the new norms that we've been talking about for employee and customer engagement, a whole new set of operational risks have to be considered. A couple 2 to 3 months ago, for security reported that approximately 40% was an increase of 40% in cyber attack over the past few months. Now, if you think about that's only normal, right? When we had more than 80% of the workforce accessing systems remotely, we will see increase in cyber risk, fraud risk, AML threats to the system. And with the new products and significant amount of automation, organizations will need to deal with the new normal with a whole new comprehensive operational risk management framework. Sultan talked about workforce and the new way of doing things, and I believe there was a webinar earlier on that as well. And following the sort of remote working arrangements that have already been put in place, the question is, what are the returning to workplace arrangements looking like? Will we ever get to the old way of work? And that's the big question. I mean, my personal view is gone are the days. I think the new norm is there to. Over the last 3-4 months, we've seen employee engagement significantly improve as we become more used to the new norms. Productivity and efficiency has increased with an effective transition to work from home, and a greater sense of trust has developed between employer and employee. The question is, do we ever then need these large head office building structures anymore? And only time will say if that is required as we move more towards a certain population working from home and hot desking becoming more prominent. I think one I also want to highlight, and it's a very common phrase which is used, the world is your oyster. And I believe is very true now from a talent pool perspective. If you think about it, a certain percentage of employees will primarily work from home going forward. Then why would you restrict having employees based out of UAE only? Why not tap into the talent pool anywhere in the world when working from home becomes very, very normal? You then want to risk governance and regulatory compliance reporting. So the pandemic has challenged the operating models of financial institutions, creating bottlenecks to meet a lot of the governance obligations. Risk and regulatory compliance has been a significant focus in the last few years in any case. However, keeping in mind the easing of customer journey, there is expectation of a lot of automation in this space. I'm sure you've all heard about RegTech and SupTech. So we've talked about RegTech, which is regulatory technology, in the past quite a bit. But I think now the focus is shifting in marrying RegTech with supervisory technology, and it's moving towards a lot more supervisory technology as well, which will basically make reporting to regulators on a live basis rather than waiting for month ends or quarter ends. This crisis has taken its toll on capital, liquidity, and revenue as well. Both Slim and Adil will talk a bit more about this, but capital position has been challenged, and the crisis has taken a bit of toll on the credit quality of the books. However, I must commend the local regulators acted very, very fast and very well to recognize the stress and provide some of the reliefs that I previously spoke about. On the insurance side, we will see asset liability management for the insurance sector to be a bit challenged, as we've seen the market's been quite volatile. And if there are significant claims and payouts which have to be settled, this may result in exiting from investments at a discount. Although we haven't seen a lot of that come through yet, but this is something that we need to focus on. And just finally, before I hand over to Slim, revenue compression. The FS industry has stepped forward in a significant way to support the economy and customers with the 6-month deferral program, in most cases without interest to be settled as well. Now, this effectively means that the revenue for the year will be compressed. And add to that the low interest rate environment and a highly insulated economic support agenda in the region. It will not be easy for banks and insurance companies to increase their lending rates or premiums respectively to offset this compression. Now, let me just stop there, and I'll hand over to Slim to talk more about opportunities and challenges and opportunities from a banking sector's perspective.
Thank you, Abbas. Good afternoon, everyone. Without doubt, the pandemic is having an unprecedented impact on all sectors, including financials and particularly banks. And this is not only in UAE or the region, this is globally, right? And while the UAE government and the central bank have been proactive and have taken, I have to say, effective measures in order to support the banking sector, there are still some challenges that the banks in the region are facing today and will continue to face, at least in the near future. Of course, these challenges could be turned into opportunities, and we'll talk about opportunities later, but let's first focus on the challenges. And I will start with the first challenge, which is liquidity pressure. And this is expected, right, because of the drawdown, because of the increase of the utilization of the savings, the deferral of loan payments, in addition to the pressure on the government deposits due to the low oil price, along with, of course, volatile and stressed equity and bond markets, although we have seen some recovery recently, especially in US. I think insurance liquidity supply for the markets will be a big challenge today for banks, as banks will be required in the same time to continue lending and supporting the economy in such a difficult time. But in the same time, banks are required to maintain adequate liquid buffer and as well as stable fundings. The next challenge I would like to talk about it for banks is the increase in provision. In fact, with the current situation, we are expecting asset quality to deteriorate. Non-performing loans are likely to surge by the end of the year. And we have seen banks actually started booking higher provision in their first results for the quarter. And we expect this to continue for the next quarter, especially now that the banks are following the IFRS 9 regulatory requirements, where provisions have to be taken based on a forward-looking approach rather than waiting for the loss event to occur and happen before credit losses are recognized. Credit losses are expected to be elevated across almost all sectors, although we believe that the travel, tourism, and entertainment sector will be the hardest hit. Oil and gas lending are expected to be also challenging, with the ultimate outcomes depending heavily on the geopolitical risk affecting both the oil production and the oil price. As we expect pressure on the real estate, banks with significant exposure to the real estate should be really extremely careful, I have to say, and proactive in order to prevent the increase and the surge in the credit default, but also in order to prevent the deterioration of the value of the collateral of the loan in case a wave of distressed sale of property assets happens in the region. Pressure also is expected on the SME side as well in the retail segments, as many people are losing their jobs, with particular attention to the people who are self-employed. In addition to the deterioration of the asset qualities and the liquidity pressure, I think banks also will face the serious challenge, which is the revenue compression. And this is, this is expected because first, if you look at the fees income, I think we are expecting a drop driven by lower consumer spending in retail businesses, in addition to the fact that many fees and charges have been actually waived by the central bank. When you look at the interest rate side, we expect the net interest margin, the NIMs, to remain compressed as rates remain low, and we believe it's going to be lower for longer when it comes to the interest rates. The other challenge I would like to talk about it for banks is around operational and cybersecurity risk. With the majority of people today working from home and transaction becoming more digital, I think it's normal and expected to see an increase on cyber attacks and frauds. However, banks need today to recognize that the cybersecurity is not purely a technology problem, but rather a wider business challenge that requires business ownership with a strategic plan along with the clear aligned support from technology team. We think that cybersecurity is important for both actually banks and consumer, and this have been confirmed based on the latest banking survey that we have conducted at KPMG. Well, notice that the majority of consuming are expecting their banks to focus on digital security and personal data safety, and this should be the top priority according to them. The last challenge I would like to cover here is around the service offering and overall business model for banks. I think without doubt, COVID-19 has changed the consumer behavior. So if you look today, for example, at the retail sector, you will see people saving more money, spending less, using less their credit cards, and rethinking any long-term commitment decision. And this will definitely have an impact on consumer finance businesses, and banks will need to take this into consideration and review their business model, as we really think that there will be today a shift between profitable products. For example, product which was before in highly demand and it was profitable could not be the case today. So that's why we think that the current situation today is creating a live test for the consumer experience and omni-channel functionality and capabilities. Banks will need to adapt to the new customer norm. They will need to respond to latest social and behavioral changes, including how consumer today select channels, how consumer today select their products, and overall, how consumer today bank for their individual financial needs. Talking about needs, I think we need to bear in mind that the need for financial products and banking products will not go away even if we are staying home. So even if we are staying home today and working remotely, doesn't mean that we will not need banking products. It's not the same products and services that the banks used to serve years ago. So that's why banks today need to be agile, to be flexible, and need to be innovative. I think that's all from a challenge perspective. But of course, as we say, with challenges came opportunities, and we think that the COVID-19 is a great catalyst to turn these challenges into opportunities. And we start with the first opportunity we are seeing for banks today is around the capital and liquidity model review. In fact, with the volatility that we are seeing in the market today, we think that's a good opportunity for banks today to review and adjust their capital and stress testing model in order to increase the responsiveness to external factors and improve the overall predictability of their risk models. We also believe that it is today opportunity for banks to review their risk functions, as we believe at KPMG that the risk function of the future must assume a much more proactive role and be systemically involved in all decisions. The next opportunity we are seeing for banks is around the business strategy. I think the current situations has clearly shown that the banks that concentrates all their assets toward the specific businesses and specific products are the most vulnerable. And this calls for an opportunity to review the business model and the risk appetite for banks. We think it's a good opportunity for banks today to review and optimize their balance sheet. In fact, it will be good for banks today to take a deep dive into their balance sheet and see which assets should be kept, which assets should be sold, which asset that can be swapped, and maybe focus on the core asset, at least for the short and the medium term. The next opportunity that we are seeing for banks is around operational resilience improvement. I think without doubt, the COVID-19 is testing banks' operational resilience and continuity planning in unprecedented ways. Today, with more consumers and more employees working remotely, banks are really working hard to ensure their safety by reorganizing workflows and considering extreme scenario not often built into existing business continuity plan. And thus we see opportunity today for banks to adjust and to review their business continuity plan and make sure that they are prepared in case another crisis happens. The other opportunity that I would like to cover here, and I think everybody is talking about, is without doubt the digital transformation. I think everybody agree with me that COVID-19 is the digital accelerator of the decade. You know, I was reading during the weekend an article covering a study done by a US cloud company by the name of Twilio, where they have indicated that on average in US, the COVID-19 has accelerated communication digital strategy by 6 years, which is just amazing, 6 years, you know. I have to say that we have seen before banks migrating to remote channel, to remote management, creating and developing a new innovative product. But I think the level of speed we are seeing today is just phenomenal. And the pandemic is not only accelerating the digital adoption, but it's also eliminating bureaucracy. And I think this is something very good for banks, which allows them to be more efficient. Last but not least, I think this is an opportunity for more synergies and more collaboration between banks and the fintechs. And we are seeing, I think, the relationship evolving in a positive way. The last opportunity that we are seeing for banks today is around cost optimization. Definitely, cost control continue to be the top priority for all banks, actually. And we believe that there is an opportunity today for banks to review their cost structures and have a leaner business model. Needless to say that the cost should be today at the center of any strategy today. This is, I would say, the recipe for all banks, including the Winners Bank, also the travel banks. And this should not be difficult because today there are many levers, I think, that they can be accelerated and many areas of cost that can be readdressed, such as branch cost, especially here in the region where we know that many banks that have a large branches network. And we think with this digital transformation journey, this is an opportunity for banks today to look and see where they can rationalize and where they can cut costs. I think another important point that I would like to highlight here is, although the digital transformation, I think, is highly recommended and needed today, it's important to link it to the cost effectiveness. In other words, if you innovate, if you automate, it's good, but you need to make sure that you are taking cost out. Why I'm saying that? Because we have seen before many great initiatives, many great innovation, etc., taken by banks without real significant result on the cost basis. And this cannot work anymore. That's why banks today need to make sure that there is a proper business plan attached to any digital investment decision that ensure a strong commitment to reduce cost. So to conclude, yes, there are challenges, but these challenges are creating opportunity. And with the support of the government and the strong leadership, we believe that banks in the region will survive and will become maybe the heroes of this crisis. It's not the first time that we have a crisis. It will not be the last time. And we believe that the banks that have done their homework will emerge stronger, leaner, and most importantly, more innovative. With that, I will hand over to my colleague Adil so he can cover the insurance part. Adil, over to you.
Thank you, Salim, and good afternoon, everyone. It's a pleasure being here in front of you today. So if I can just quickly cover the insurance sector, as you can see on the slide, when we talk about the challenges, the very first point there is pressure on premium and pricing. I think considering that for many insurers, policies were renewed in Q4 of 2019 and Q1 of 2020, insurers have largely been protected in terms of their underwriting revenues at the start of the year. However, I do believe that renewals are likely to show a deterioration or a declining trend into Q4 of this year, which will inevitably continue next year. As customers face that harsh reality of cost cutting, some of those measures are already leading to cost optimization strategies being initiated or staff layoffs being implemented by companies. And this will need to be considered by insurers as they look at changing demands from the market. Clearly, a large number of customers potentially disappearing overnight will result in lower volumes of business being underwritten. However, considering that in the UAE, you have more than 60 insurers in the market, this will inevitably have a double impact because not only are insurers competing against each other to retain their existing customers, but also to attract new ones, and hence resulting in very competitive rates being offered in the market. I think from a pricing perspective, as Abbas already alluded to in his earlier slide, we are beginning to see insurers offering discounts on premium renewals, particularly in the motor business. And I do believe, I think that reduced or discounted premiums may become the norm in the medium to long term as more and more insurers are compelled to follow suit in order to remain competitive. Moving on to the next point, claims reserving recalibration. So from an actuarial perspective, the current pandemic will pose many problems considering that insurers tend to rely on past trends to predict future events. As this is clearly an unprecedented event, it will become more difficult to estimate IBNR. And as the frequency of claims has dropped to levels unlikely seen before by many insurers, I think additionally, there will be challenges in pricing both new and renewable business, where insurers only have claims data which is available for the past year. And the future, as we know, is still uncertain as businesses and individuals try and get to grips with resuming working from office. I think in terms of the claims reserving process, new methodologies will be needed to identify the change in consumer behavior during these lockdown restrictions. I think it is very likely that insurers will need to move towards a frequency severity method for their reserving if this is not already being done by their actuaries. The next point in terms of our challenges, impact on asset values. So due to the liquidity issues which are being faced by customers, clearly collection of receivables is expecting to become increasingly difficult and very challenging. I think this will lead to potentially higher impairment charges against receivable balances that insurers will be booking. As a result, I do also expect to see that insurers will be paying even more attention to their credit controls and their collections process. And it should be worthwhile noting that in the UAE, you still have some insurers who are preparing their accounts under IAS 39, whereas others have adopted IFRS 9. So there will inevitably be differences between the amounts that insurers will be booking as impairment on the receivable portfolios, and they may not be comparable like for like. Continuing with the asset value issue, I think to further compound the issue, prevailing volatilities in global and local markets will likely cause impairments on financial investments which are being held by insurers. For those insurers who have not really adopted IFRS 9, this will also mean that impairments will be routed from OCI into their profit or loss, which will further dent the net profits of those insurers for the period. I think, in short, really solvency positions will need to be carefully monitored as asset values deteriorate and markets continue to remain very volatile. The next point, cybersecurity, as already mentioned by my colleagues, I think insurers too will be facing an increase in cybersecurity weaknesses that can and are being exploited by cyber criminals. I think addressing these risks is even more challenging for insurers as they struggle to maintain adequate security levels with the increased threat landscape, but also with the very, very limited or tight budgets that they typically have to work with. I think it is very important that the insurance sector adapts to this crisis and addresses these cyber risks as a matter of urgency. I think the final point that we've got in terms of the challenges in the sector, increased solvency risk. So given the very challenging macroeconomic scenario that my colleagues have already alluded to, interest yield curves flattening, the oil price eroding, as well as potentially further government or regulatory intervention that might still impact this sector further, I think it is inevitable that some insurers' asset positions are expected to significantly reduce in value. And this, along with the potentially large reductions in investment income, may actually have a devastating impact on some companies. All of this may actually lead to some insurers breaching minimum stipulated solvency requirements, which have been set by the insurance authority, and potentially resulting in them becoming insolvent. However, it's not all doom and gloom. I think if you look at the key opportunities, and again, this is extremely relevant for the insurance sector. The first point there, digital sales and distribution. So COVID-19 might actually prove to be a catalyst for innovation in the insurance industry, contributing to long overdue improvements in customer experience and personalization. We are already beginning to see collaboration platforms gaining popularity with insurers who recognize the need to transform. As part of that transformation, insurers will need to review their channel strategy approach in order to serve that demand. And I think this may entail a much greater investment in trying to integrate their channels, as well as creating digital pathways on an end-to-end basis. We're already seeing that insurers are looking at adopting digital solutions, things like chatbots, robotics, use of telematics, as Abbas alluded to earlier, data analysts, and even digital point of sale tools. I think this, in turn, will allow the employees of insurance companies to be reallocated to more important tasks rather than just administrative roles. And I think these changes will very much lead to a greater level of personalization and will inevitably change the customer experience and the value propositions that are being offered by insurers. The next point that we've got on our slide, alignment with new metrics and KPIs. So insurers will need to re-strategize their KPIs in light of the changing business environment that they're currently experiencing. I mean, this includes managing their costs, understanding their profitability, reviewing their solvency margins, realigning their reinsurance arrangements, and critically reviewing decisions like dividend payments in the future. I think at the moment, insurers have certainly completed examining policy terms to assess the appropriateness of COVID-19 claims and also evaluating the impact that that might have on their claim liabilities. I think reserving benchmarks will be updated and underwriters will currently be renewing their premium rates considering the trends that are being witnessed in the current market. They will need to revise policy provisions and also review things like exclusion clauses within the policy documents. Potentially, we may see insurers terminating certain lines of businesses going forward in order to continue profitable growth. The next point that we've got there in terms of agile finance and investment systems. So, as has already been mentioned, technology and innovation are changing the world of insurance, and the unprecedented volatility in the market has certainly led to a need for a much greater agility in financial and investment systems to report in very dynamic environments. I think companies are introducing solutions to fundamentally alter this landscape, some of which, for instance, include a complete redesign of their infrastructure platforms, taking into account changes like advanced analytics, incorporating cognitive contract management tools, and embedding automated operations involving things like robotics. The next point in terms of the reassessment of the risk landscape. So insurers will need to be very meticulous when examining the current trends in their underlying portfolios as they plan for their business in the next coming 12 months. This will include also checking if, for instance, their internal controls are still relevant in a digital world, with weaker or outdated controls having to be enhanced or replaced with newer ones. They will need to ask themselves whether there has been a detailed all-round assessment of this new risk landscape, looking at areas like investments in light of the market volatility that we've discussed, counterparty risks and product relevance. So for example, will the number of deaths reported likely increase as a result of future increases in illnesses? I mean, considering that we still don't have a vaccine out there, this is a critical area of consideration in terms of medical, but also life. Insurers will also need to look at their cybersecurity risk landscape and also the operational risks arising from a business continuity perspective. Finally, in terms of mergers and acquisitions, as already highlighted earlier, I think that thinly capitalized insurers may face solvency issues, which in turn will lead to increased merger activity within this sector in particular. Indeed, there has already been a spur of activity within the industry in this regard, as companies are looking to transform operationally and benefit from synergies like adopting new technologies, getting access to new locations, accessing other customer profiles, and also re-engaging new products that they didn't have access to. I think we're already beginning to see regional regulators promoting and encouraging M&A within this sector. And it is a trend that is likely to continue growing, especially considering we have 60 insurers in this market at the moment. So that's really a summary of what we see are some of the key challenges and opportunities within the insurance sector. You've now heard from my colleagues and I on some of the key issues, as well as the opportunities which are being faced with the banking and the insurance sector, and how we see the future of financial services potentially panning out in the immediate aftermath of COVID-19. With that, I would now like to hand back to Sultan in case there are any questions from the audience.
Adil, thanks, Jans, for the interesting presentation. We were actually receiving a lot of questions on the Q&A, and I'm going to start. I don't know if 15 minutes is enough to go through all the questions, but we'll try our best to cover as much as possible. So the first question will go to Abbas. How developed are GCC banks when it comes to digital offerings as compared to peers outside the region?
Very interesting question, Sultan. I've been asked this question quite a bit over the last 3-4 months. So look, banks and other, they're faced with tough times, and technology can help mitigate the negative effect for customers and businesses. I think the players relatively in the UAE rank below developed Asia when it comes to purchasing digital financial services. But having said that, there is some sense of urgency in stepping up the pace, and we've seen a lot of that happen over the last 6 months, and more is expected over the next 12 months. Nevertheless, I think many regional and banks offer sophisticated banking apps and online services. But we don't see bank branches. I know Slim mentioned rationalization, but we don't see bank branches disappearing in the short term, at least. Despite digital offers, we believe that the physical channels will still play a key role in this. It's just that the physical channel requirements will have to be repurposed for high value propositions. There is reason why banks should limited to offering only traditional core banking services as well. And we're seeing a lot of talk about banking the ecosystem, where you would focus on helping the consumer simplify their daily lives without leaving the bank's portal. So I'll give you an example. So take WeChat, for instance, right? WeChat, which enables users to send messages, make payments, invest, order taxis, buy bus tickets, and many more just from a single integrated system. Today, customer experience expectations are set by not financial institutions, but non-financial organizations, the likes of Google's, Amazon, Facebook, Apple's, etc. There should be no need to visit different platforms, and I think that's what the future would look like. The market could move from a product push sales mentality to a proactive one, which encourages needs-driven solution offerings. Sultan, back to you.
Yeah, thank you, Abbas. So, Jones, I'm not gonna say I'm gonna guess, but I believe from what you've said on the presentation, I'm gonna allocate the questions each one of you. If you believe it's not you're not the right person to answer, so you can really assign it to someone else from the team. Because Slim, you've referred to fintech. I have a question here on fintech that says, how do you see the relationship between the fintech and banks post COVID-19?
Thank you, Sultan. It's a good question indeed. I think the relationship have evolved in a positive way, and collaboration between banks and fintech, I think, could be a key today to find solutions in the new environment that the COVID-19 is bringing to us. Fintech, I think, today is not an issue, is not the problem for banks, is not a competitor anymore as it was before. I'm personally think that the fintech should be part of the solution to the problem, and I think going forward we will see more alliance and more partnership between fintechs and the banks. So that's in short, if you want, the relationship. I think is going the right way.
That's great. That's great. Thank you, Slim. Question for Adil. Adil, what are your thoughts about business interruption claims, and have you seen insurers settling them? Adil, you're on mute.
Sorry, can you hear me now?
Yeah.
Apologies. So I think it's worthwhile noting that policy provisions have evolved since the SARS outbreak. Business interruption insurance is generally not designed or priced to provide coverage against communicable diseases such as COVID-19. Policies here that we've seen certainly generally include exclusions for such a risk. It is likely that only a very small number of insurers have issued policies which will have exposure to pandemics. As most exclude such coverage, they are unlikely to be settling claims which are being raised by customers on account of business interruption. But I think this is an area which will likely to result in, again, protracted, drawn-out negotiations between insurers and customers as they try and understand and interpret the specific terms and conditions that are being written into policies. At the moment in the UAE particularly, I have not seen many business interruption claims being paid out or approved, but I know that this is a hot topic globally because I know regulators are also currently deliberating and seeing if this is something that maybe they might need to enforce on insurers, but we'll wait and see.
Thanks, Adil. I have a question. I believe, Slim, you can cover this. It's about the impact of COVID-19 on M&A activity in the banking and insurance sector. So do you see further consolidation, especially with companies having common government shareholding?
Thank you, Sultan. In every financial crisis, the number of banks or financial institutions merged has exceeded the numbers of banks and financial failures. So I think considering the area of growth is limited today, so the consolidation is a solution. So we believe that banks with the strong capital and cash position today have opportunity to grow unorganically by identifying the right target. And the target could be another financial institution, not necessarily a bank, for example, when it talks about bank. It could be a fintech player and do consolidation. So we are also expecting regulators in the region to promote and encourage the M&A activity, especially with the entities that have common shareholders. So to answer your question, yes, we are expecting more M&A for the sector in the region.
And it makes sense, especially in tough circumstances where you can join forces, find common synergies, and so on and so forth.
Right.
I'm gonna ask a question to, I believe this is probably Abbas can take this. So it's on, do you think the accounting standards will change post the crisis? So certain governments are allowing for either deferral of IFRS 9 provisions or amortizing such provisions over a few years. What are your views on this, Abbas?
Sure. I think before giving just to be clear, so yes, there have been deferrals being announced. International standard has come out with some guidance in terms of deferring of the impact is more from a regulatory aspect rather than sort of having an impact on P&L. But let me just take you back. So when IAS 39 was issued or reissued, I must say, I think early 2000, and then we had a financial crisis. IFRS 9 came as a game changer in response to that crisis, aimed at improving accounting and reporting of financial assets and liabilities. But I think I do have a view. You cannot have one set of rules for boom times and one set of rules for bust times. Standards need to be consistently applied. But having said that, we have seen numerous guidance and clarifications by local regulators in different jurisdictions as far as the application of the standards are concerned. And I commend the regulators in stepping up and in addressing some of these challenges, because there's still quite a bit of uncertainty of what impact you would expect. And we've seen that as part of Q1 results, not just locally, regionally, globally. And as time passes by, we'll see a bit more impact coming through. One thing is clear, this pandemic is different from the global financial crisis in 2008. I think today, the banks, in my opinion, have to play a much more significant role in supporting the economy. Whereas compared to in the past, I think the global financial crisis was brought upon by the banks on themselves. This is very different. And hence, it would not be too unreasonable, if I may say, to ask for a pragmatic approach application of the current rules. Look, so now to answer that question directly, we do not expect any wholesale changes to accounting rules at present.
Thanks, Abbas. I have a very interesting question, honestly, and it's, I believe Adil can answer this coming from insurance background. So, Adil, we've discussed over the presentation several times cybersecurity, cyber attacks, financial crimes, and so on and so forth. And we've seen this recently. There has been a massive hack on Twitter accounts for big names and celebrities in the US. So the question is from Muhammad. There is a lot of focus around cybersecurity. The insurance can tap that market by offering cyber insurance. What's your view on it?
Look, I think it's a very good question, and I think we are already seeing insurers in the market who have been introducing cyber insurance as a product. I think the key challenge that insurance companies will now have is considering the landscape has changed significantly from a cyber attack perspective. It's very important and critical that insurers are able to price these sort of policies, right? What is the risk of a cyber attack happening on a customer? And in order to do that, insurers need to understand, well, what sort of controls and what sort of protection do you have as a customer on your platforms, on your IT systems? Because clearly now, we're seeing an increase in usage of multiple personal devices that people are now using whilst working from home. Staff are accessing organization data from different locations, different geographies, and different devices. And typically, not all of them would have been protected by, let's say, a company's security profile. You could definitely look at and assess the risk internally, but now that risk has grown significantly. So absolutely, there's a lot of opportunity there for insurers to look at offering cyber insurance. And I think it's very critical that they try and understand to what extent potentially are exposures that are existing in customers, and how do we price those risks? Over to you.
Quite interesting, Adil. I have a question on dividend policy. I believe Abbas can take this. So, COVID-19 impact on dividend policy of banks, financial institutions, insurance companies, and knock-on effect on investment income for FY 2021. Your opinion?
I think that's a statement of fact. I mean, if dividends go down, it does have a knock-on effect. But I think action around that. I mean, at this stage, if I take banking specifically, the central bank always had this rule around a certain cap of what dividends can be disclosed, and it was 50% of what profit you make for that year. Obviously, if profitability is down, that 50% automatically becomes lower, right? And as a result, less dividends would get impacted. But again, because of some of these reliefs provided by the regulator around capital reliefs and so on, I think that will hopefully give a impetus into the market. But again, I mean, there have been some actions internationally as well in limiting some dividend payouts, just to make sure that organizations are well capitalized and protected during a stress time. But Sultan, having said all of this, look, we all need to accept the fact that these are unprecedented times, where we see a lot of jobs being rationalized, companies being shut down. I think an acceptance of having lower dividends for 1 year should also be accepted. But that's my personal view, sorry.
Sultan, if I could just probably add as well, it's interesting to see that if you look at other jurisdictions, we have seen regulators actually requiring insurers to stop dividends or to suspend and freeze the payout of dividends. So I know it's not happened here yet, but definitely in other jurisdictions, I think there is a concern around the cash reserves and the buffers. And in order to be ready for the COVID-19 claim payouts, we are seeing regulators in other territories requesting insurers not to pay dividends. So we'll wait and see how that pans out for 2021.
That's quite interesting. I believe a very, very valid and fair opinion, Abbas, on that. It's unprecedented times, and adjustments should be as well considered. I just want to refer to something you've covered in the presentation. Several initiatives that have been taken by the UAE government, and I believe we've received a comment from one of our colleagues from another governmental entity referring to the waiver of fees from the Abu Dhabi municipality on, let me read it in specific. So it's the real estate as of the municipality. There has been a waiver of fees till the end of the year. So, and they have achieved and delivered 6 off-plan projects. So this is just to mention that this is not a comprehensive listing of all the initiatives. There has been a comprehensive document issued by the UAE government of 260 plus pages of all the initiatives that have been taken by the government to battle the COVID-19 impact. So I'm going to have one last question. Okay, that's from Rizwan. Do all banks, especially global banks having operations in GCC, need to adjust their ECL for their clients based in GCC by year end?
Should I take that? So,
Please.
yeah, I mean, I think regardless of international banks being based in GCC or local banks in the GCC here, I think IFRS 9 is consistent for all. Yes, local regulators have come up with some variations to certain extent, but by the end of the year, everybody has to follow IFRS 9. And regardless it being a foreign bank or a local bank, IFRS 9 needs to be applied consistently. One point to raise, obviously, we keep on talking about and refer to IFRS 9. There are some organizations or branches based here which follow US GAAP as well, because there are US banks present here as well, right? Need to follow US GAAP, and at the start of this year, US GAAP had some changes within the accounting standard around expected credit loss, and hence we've seen number of US banks reporting much more provisions at the start of this year than they have in the past.
Yeah, on that point, Abbas, I've seen recently a post from Bloomberg, which states that only 4 banks, that's Citigroup, Bank of America, JP Morgan, and Wells Fargo, the expectations for Q2 of 2020 provisions was around 25 billion. So it's not it's one of time, and we need to adjust to it as mentioned earlier. Any final words from your end before I close?
No, just on behalf of my colleagues, look, thank you so much for this opportunity. I just hope this was useful for the audience. Apologies if we haven't addressed all your questions. We were limited by time. Look, you have our contact details. Please reach out. Happy to answer any questions. But once again, thank you so much, and please stay safe.
I want to thank you again, Abbas, Adil, and Slim, and the whole team behind the scene working and supporting us to have those successful sessions. I want to thank as well the audience for attending. It's been 3 minutes post the scheduled time, so we tried to cover as much possible of your questions. Be tuned with us for next Tuesday session with Gartner on the evolving role of data and analytics and artificial intelligence during disruption. Until then, stay safe and have a good day. Thank you again.
Thank you.
Bye.
Thank you.